Let's bring in our senior economics reporter, Steve Leisman, on this issue of, Steve, it's good to have you back on the program, of higher for longer, right? And that is what your Fed survey seemed to show, right? Respondents raised their outlook for the peak, and they think the Fed's going to stay at the peak for about 11 months before cutting rates. So that suggests higher for longer.
Yeah, hike and hold, Scott. And by the way, our Fed survey, it's the CNBC Fed survey.
I know,
but
I feel like
own
it's
a little
yours.
Piece of it.
I feel like it's yours.
You know,
you,
I do
us,
it on behalf.
You, we're all the same.
Exactly. It's all the same. It's all family. But here's the deal. Just to be a little careful with the average, Scott. We've got some guys thinking the Fed gets there and stays there for 3 months. Other guys think the Fed gets there and stays there for 24 months. I think it's important, though, to look at the peak rate. The peak rate now is up 426, which is 40 basis points, 43 basis points higher than the July survey, but a little bit under where the market is right now. The market right now is at 450. So there you go. 75 expected for the meeting. 426, the peak rate reached in March. 11 months at that peak rate, and then you can see a pretty hefty probability of a recession, 52%. So, yeah, some guys think it's the 3 months at the peak rate, some guys 24 months, and a bunch of folks at the 11 to 12-month area, and that's how we get to that average. But I think the story, Scott, on this show and in the market as well, because this show does a great job of really sort of saying what's going on in the market, which is more embracing of the idea that the Fed reaches that peak rate and hangs around there for a while in an effort to stamp out inflation.
What about this idea of that people are embracing, Steve, is the idea that the Fed's doing too much and that it's going to continue to do too much? It's a Sternlicht, it's Gundlach, it's others. It's the oversteering is the word that Gundlach used with me out where we were both out in California. What about that notion? How sensitive do you think the chair is to that?
I think he's sensitive to a point, Scott, but this is an interesting question, right? Which is there has to be some pain, some softening. Some of the things that you've heard from people are exactly the things you would expect with a softening economy. And the question becomes, when do you sort of hit the panic button? When is it too much? I think Chair Powell expects to hear some of the things he's been hearing on our air regarding concern about going too far. And I would also expect that he would think he would hear those most loudly from those in the real estate industry, maybe some in the auto industry. Basically, he would expect to hear from people in interest rate sensitive sectors.
Right.
He would also expect it to hear from guys in the stock market, right? Because they're the ones taking it on the chin. But looking at the broader economy, the idea that we have a forecast for 1.5% growth this quarter, I think he would think that's kind of a win for the broader economy, and he's hearing what he would expect to hear from certain people who he would expect to have the most pain in this rate.
Well, it's interesting though. You use the word softening. It's what you would expect to hear from those in a softening economy. Barry Sternlicht, if he was sitting here, would tell you it's a crashing economy, at least in his economy, right? The one that matters most to him. Now that plays into this.
Well, I mean,
go ahead.
No, I mean, you know that story about the blind guys feeling the elephant, right? They all have a different piece of it, right? I'm not saying that Barry is that guy, but you know, he's in a particular industry that's going to take it really hard.
The other idea is how hard is Powell willing to let it go, right? That speaks to this Nick Timrose thing from the Journal, who said, and I'd love your opinion on this, Powell scrapped his original Jackson Hole speech and decided to deliver usually brief remarks with a simple message. The Fed would accept a recession as the price of inflation fighting. You've said that they may, in fact, be willing to do that. Is this becoming now more clear than it ever has, that he's willing to break it as long as he doesn't destroy it?
Yeah, that was my immediate analysis from the Jackson Hole speech when he used that phrase, pain. I guess he'd used it for the second time, but right now, in that speech, it stood out in bold relief. And it's why I keep asking him the question, and asked him twice at the last press conference. I may ask it again, Scott. I'm not really sure. But the question was, how does policy change if it is a recession? And he didn't really answer it last time. He didn't answer. Maybe he's ready to answer it now. But I think the answer is, it depends on how severe a recession is. I think if it's a mild recession, I don't think it changes very much, because I think the Federal Reserve First of all, remember, Scott, they brought up that 1970s analogy where they talked about the idea that the Fed hiked rates and then stopped, right? And then inflation came back. They don't want to repeat that. That's one. The other side is that the Fed is willing to accept some increase in the unemployment rate, maybe a couple negative quarters of growth, and if they're mild negative quarters, I think that and the result is it stamps out inflation. I think the Fed would count that as a win.
Yeah, we'll find out, I guess, as to whether investors are on or off sides with what the Fed is ultimately going to do, because Mohamed El-Erian is listening and says higher, faster, and for longer. And I'm not sure that all investors are at the point of accepting that. And we're going to find out. We'll hear from you tomorrow. Ask the question again.
One quick comment on that, Scott. One quick comment, which is the upside of this, maybe the Lebenthal thesis might be the faster it gets there, the less time it has to spend there, which is that maybe if it does a strong job on the front end, maybe there's less work to be done on the back end.
Yeah, although he would also say maybe they don't even have to get there. So this thing it's confusing. Steve, thanks. We'll see you in D.C. For the presser.
Sure.
That's Steve
Pleasure.
Leisman, our senior economics reporter.